Welcome to This Explainer. Okay, today we're objectively unpacking a literal multi-billion-dollar question. Exactly how does the global climate transition pose a tangible, measurable threat to oil and gas portfolios? We're going to look squarely at the numbers using the precise toolkit laid out by the SASB standards for the exploration and production industry. If you've ever wondered how the market actually evaluates energy transition risks on a balance sheet, well, you are in exactly the right place. Let's dive in.
Think about it. What actually happens to an oil company's valuation if, for whatever reason, the oil just has to stay in the ground? We really need to talk about the existential financial threat known as stranded assets. See, if greenhouse gas emissions are controlled to limit global temperature increases, exploration and production companies might literally be unable to extract a huge chunk of their hydrocarbon reserves. Between regulatory limits, carbon pricing, and just the sheer competitiveness of alternative energies, global demand could take a massive hit. And we all know, if demand drops, prices drop. Suddenly, the cost of extracting the oil outweighs the potential profit, which leads to massive asset impairment.
So, here's our agenda for today. We're going to cover 1. The stranded asset threat, 2. Stress testing oil reserves, 3. Calculating embedded carbon, 4. The pivot to renewables, and 5. Future-proofing capital expenditures.
All right, Section 1. The stranded asset threat.
Before we can even calculate risk, we have to know what we're actually valuing, right? The SASB framework relies on industry standard classifications for reserves, specifically proved and probable reserves. Now, these aren't just educated guesses. They are rigorous estimates of the economically viable and legally extractable quantities of oil and gas. But here's the catch, and it's a big one. That phrase, economically viable, is entirely dependent on market conditions and regulations. If regulatory actions to curb emissions kick in faster or harder than anticipated, the foundational value of those proved and probable reserves could be severely impaired. And that could happen over a really short period of time.
Moving right along to Section 2. Stress testing oil reserves.
So how do we actually figure out how sensitive these reserves are? Well, the SASB standard directs analysts to compare vastly different futures using price trajectories published by the International Energy Agency, or the IEA. On one side, we've got the current policy scenario. That's basically business as usual, assuming no changes in policies from the midpoint of the year the outlook was published. But then, on the flip side, we have the sustainable development scenario. This one models an energy pathway that's actually consistent with limiting global warming to 1.5 degrees Celsius. This scenario assumes some aggressive policy commitments, serious carbon pricing, and major shifts in demand.
And this brings us to the ultimate mathematical reality check. As an analyst, you take the IEA's price and demand assumptions for each scenario, and you plug them right into a standardized matrix. As you move from the business-as-usual base case down to the really aggressive sustainable development scenario, introducing stricter carbon pricing and lower fossil fuel demand, you calculate the shrinking volume of reserves that actually remain economically viable to extract. It is a stark, undeniable calculation of transition risk.
Okay, Section 3. Calculating embedded carbon. If we want to calculate the estimated carbon dioxide emissions that are embedded in proved hydrocarbon reserves, we use this exact equation. E equals R times V times C. Let's deconstruct that real quick. E is the potential emissions in kilograms of carbon dioxide. R stands for the proved reserves in gigagrams. V is the net calorific value, which is basically just the energy content. And C is the effective carbon dioxide emission factor. Oh, and if a company doesn't have their own specific data for this, SASB says to just use the default carbon content values published by the Intergovernmental Panel on Climate Change, or the IPCC. When you run that formula, you don't get some vague, abstract concept. You get a hard number. You get the total metric tons of CO2 equivalent that are physically locked within a company's proved assets. This estimate applies a factor for potential CO2 based purely on the reserves, which gives investors a very stark, objective metric of the carbon intensity sitting right there on the balance sheet. Simply put, entities with more carbon-intensive reserves are the ones staring down the highest regulatory compliance costs and absolutely the greatest transition risks.
Next up, Section 4. The pivot to renewables.
A really crucial metric in the SASB standard is tracking the capital split. We want to see exactly how much money is flowing away from traditional fossil fuels and into replenishable sources. This covers the total amount spent on alternative energy, including capital and R&D expenditures, and the standard is super specific here. It defines renewable energy as sources that can be replenished quickly through ecological cycles. We're talking geothermal, wind, solar, hydro, and biomass. And for biomass, it actually has to be certified to a third-party standard, like the Green Energy National Standard or the Forest Stewardship Council.
But here is the real kicker. It's not just about spending the money, it's about making it back. The SASB standard doesn't just ask, hey, how much did you invest in renewables? It explicitly demands the disclosure of the revenue generated by renewable energy sales. Look, anyone can throw capital expenditure at a wind farm, but true corporate viability and a successful transition are proven by actual top-line revenue generated from these new alternative energy sources.
Which brings us to our final part, Section 5, Future-Proofing Capital Expenditures.
So how does an oil and gas company decide where to spend its capital for exploration, acquisition, and development today? Well, the SASB framework asks entities to discuss how these investments are influenced by climate regulation. First, they've got to look at the scope of regulation, like which countries, regions, or industries are going to be hit. That dictates what type of hydrocarbon they even focus on. Second, the actual structure of the regulation matters a lot. Is a region rolling out a carbon tax or maybe a cap-and-trade system? Because those affect price and demand completely differently. And third, they have to look at the alignment of time horizons. An exploration company has to align the timeline over which demand might fall with the time it actually takes to see a return on their capital expenditures. That could be a short 5-year turnaround for a shale project, or it could be a massive 20-year horizon for a deep-water drill.
If you take a step back and connect every single SASB metric we've covered today, they all point straight to the bottom line. Stewardship of capital resources that properly considers near and long-term climate trends is pretty much the only way to mitigate potential asset impairment. A company that accurately anticipates carbon pricing, actively stress-tests its reserves, and dynamically adjusts its capital expenditures, that is a company that maintains its profitability and creditworthiness in a shifting global economy.
As we wrap up this explainer, I really want to leave you pondering this one question. When you look at an energy company's balance sheet, are you valuing yesterday's resources, or are you accurately pricing in tomorrow's realities? Because, as the data clearly shows, the transition isn't just an environmental concept anymore, it's a fundamental financial equation. Thanks so much for joining me for this deep dive into the numbers, and keep asking those right questions.